Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. With the war in Ukraine, ongoing COVID crisis and changing central bank policy, the investment landscape today is intensely complicated. Joining me to discuss how portfolio managers can navigate this is James Athey, Senior Investment Manager at Abrdn. James, welcome back to the show.
Hi Dan, thanks for having me back.
So firstly, how would you characterise the risks which macro funds are exposed to?
Complicated. Without being too glib, this is as tricky a macro environment really as I think you could imagine. It was already quite difficult anyway from the outset of the pandemic to the response from governments and central banks, and then to the outcome of those responses more recently, which has obviously been dramatic shifts in the inflationary environment. And then we've moved quite quickly through the gears on the Russia and Ukraine conflict, which may potentially have really far-reaching consequences, across the globe, particularly in certain Western markets, and through similar transmissions to those issues we were already facing, which is to say, pushing inflation higher and potentially pushing growth lower.
That's very interesting. And how is the market volatility that's creating impacting the ability to manage risks?
As a general rule, the higher the volatility prevails in financial markets, the lower the gross level of risk that many investors will run. They're essentially two sides of the same coin, but you can have high volatility environments which are a little easier to navigate. You can have high volatility environments which are less easy to navigate. And I think this definitely falls into the latter category. The correlation that we're seeing across assets within asset classes, across asset classes, and the combination of that in a high volatility environment, I think is making it quite difficult to know at a portfolio level exactly what you are exposed to in some of the big beta moves. And that's obviously a concern and difficult to manage. So normally in these circumstances, reducing risk, getting to the sidelines in non-core strategies is a pretty sensible place to start.
Where we do see volatility potentially creating opportunities, for example, in relative value, how easy is that to take advantage of at the moment?
It's really difficult because, we've seen this through shock events in the past that, as the famous maxim goes, the market can remain irrational longer than we can remain solvent. And I think we're seeing this in some of the most liquid markets out there. FX, for example, positioning is possibly a bigger driver of the performance of certain assets and asset classes than fundamentals are. So you can try and position for some of the normalization or mean reversion. You can try and even position for your fundamental outlook to play out. But in the very short term, you must understand and recognize that those are not the dominant drivers of price action, and therefore things can move further against you. As a real money long-term investor, I want to be able to position for, fundamental mispricing. I think it's just important to recognize the amount of risk that you put into those strategies is appropriate given the heightened uncertainty and volatility.
That gives us a very good insight into trying to take advantage of the situation. In terms of the adverse effects this is having on portfolios, what can a fund manager do to manage those?
If you don't have Russian assets in your benchmark, in your investment universe, that's a very good start. The safest thing to do is to have no exposure to them. Now, when you're a long-only real money investor, as we are at Abrdn, it's difficult to get to a truly risk-neutral position because even if you are neutral versus the benchmark, that still means that you have absolute exposure to those assets. And so with heightened uncertainty, the risk of sanctions, the risk of stranded assets, the potential for gaps to appear between onshore and offshore Russian liquidity and Russian pricing, quite difficult. At the moment, I've taken a cautious short approach. So I own some Russian exposure, but less than the benchmark. Where I do own local bonds, own them in euro clear so that it's internationally settled rather than domestically settled to try and minimize the risk. And then in terms of the broader portfolio, understanding where those transmissions are. Geographically speaking, near neighbors to Russia, I've seen their asset prices affected. To some degree, I see that as opportunity. The Polish zloty, for example, the central bank there has said they can't think of a currency which is too strong in order for them to deal with their inflation positions. So weakness that we've seen there, we're quite comfortable opposing. And then in a more broad sense, understanding where You have oil exporters versus importers where you might have sensitivity there, and what the central bank response may be in the Western world. For now, we are of the opinion that central banks will not be perturbed from continuing down this path of monetary tightening, because the most pressing risk they face really is high inflation and unanchored inflation expectations, which this Russian-Ukraine situation really exacerbates.
Then how would you characterize the risk outlook for the rest of 2022, given that we still have this conflict, the ongoing pandemic, and these changes in central bank policy?
Yeah, I mean, you wouldn't necessarily know it by observing price action in some of the major indices. We're so used to buy the dip type of mentality, this Pavlovian response where any decline in equity prices is a buying opportunity. In our estimation, the various strands of this macro environment, broadly speaking, all act as headwinds to risk assets. We would look at the fiscal impulse between last year and this year being a negative, the monetary tightening that we're seeing, that we're expecting, being a negative, lower growth driven mostly by falling real incomes, input cost prices rising, squeezing the consumer's ability to engage in discretionary consumption, a hit to sentiment coming just from a war breaking out right in the heart of the global economy, right in the heart really of Europe. All of these suggest to us that attaching historically high multiples to equity markets is not particularly wise.
Yeah.
So as much as it's complicated across the macro environment, for risk assets in particular, we really do think that the rest of this year is going to be a tricky time.
James, that's been great. Thank you so much.
Pleasure, Dan.
I'd like to thank James for his insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net.